Okay, let's unpack this. We are diving deep into one of the most significant evolutions in decentralized finance, the Aave protocol.
Hmm.
The sources are describing its new architecture, V4, as the potential, and I'm quoting here, backbone of all finance in its 2026 master plan. I mean, that's a huge claim,
It's an immense level of ambition. To even aim to handle assets worth trillions of dollars, you need more than just a few updates.
right?
It demands a fundamental architectural overhaul of how a platform like this manages risk, liquidity, and even the speed of its governance.
Absolutely. So our mission today is to cut through that complexity and really understand the systems behind this vision. We're going to dissect the leap from V3 to V4's new architecture.
And how its decentralized governance handles the, frankly, high-stakes game of emergency risk management.
And then get into what these new features like personalized risk premiums actually mean for, an everyday user.
We get some great material, technical deep dives that detail the limitations of the older versions, the whole sort of layered defense structure of the Aave DAO,
And the actual specification for this V4 hub-and-spoke design.
which is their big answer to unifying fragmented liquidity. That's one of the biggest bottlenecks in all of DeFi today.
Okay, so let's start right there. Set the stage for us. Why did Aave even need this massive, potentially disruptive upgrade? Why not just keep iterating on V3?
Well, if we connect this to the bigger picture, you have to remember what DeFi is at its core. It's an open-source financial system on public blockchains.
All built with smart contracts.
Exactly. It's part of this whole Web 3.0 shift away from centralized, institutional control. Aave is replicating core financial services lending, borrowing, but in a way that's automated and transparent.
And AV2, which was groundbreaking for its time, really started to show its age as the ecosystem scaled up.
It did. The documentation we have points to 4 key areas where V2 just couldn't keep up.
What was number one?
Number 1 was capital efficiency. Just way too much liquidity user-supplied assets was sitting idle in the smart contracts.
So it wasn't generating enough yield for the people who put it there.
Right, which discourages people from participating. It was inefficient.
Okay, so inefficiency was a big one. What about safety and control?
Safety was limited. The risk configuration was really rigid, so it was hard to tailor parameters for specific assets. And on top of that, decentralization felt sluggish because the process for listing new assets was just incredibly slow, a bureaucratic headache.
And I remember the user experience. Segregated liquidity and the high gas costs on L1 Ethereum made even small transactions feel really painful.
So V3 was the first major pivot to solve all of that. Its mandate was basically efficiency and lower costs.
And it did that by introducing some genuinely clever features, starting with high efficiency mode, E mode.
E mode, right. This is where you can maximize your borrowing power.
So if I supply a stablecoin, say DAI, as collateral, I can then borrow another stablecoin like USDC with much higher leverage.
Exactly. The source material gives a really clear example. A standard stablecoin might have a loan-to-value and LTV of maybe 75%.
Meaning for every $100 I deposit, I can borrow 75.
Right. But if you flip on the stablecoin E mode, that LTV can be overridden to as high as 97 or 98%.
Wow, that is a massive boost in borrowing capacity. So what's the trade-off? If I get that kind of leverage, am I just taking on a different kind of risk?
That's the critical nuance.
Yeah.
You get the higher leverage, but you are restricted to borrowing only assets within that same tightly correlated group.
So stablecoins for stablecoins?
Pretty much.
Yeah.
Think of it as the protocol enforcing that these high leverage positions stick to very, very stable assets.
Got it. Okay, the second big V3 feature was about containing risk. That was isolation mode.
This was a direct response to the problem of listing new, maybe more volatile assets without putting the whole protocol in danger.
How did that work?
If governance lists an asset as isolated, it gets a strict debt ceiling, let's say $10 million. And critically, if you use that asset as collateral, you're walled off.
Walled off.
You can only use that single asset for collateral, and you can only borrow specific approved stablecoins up to that ceiling.
So it's like the protocol's quarantine zone. It stops any potential contagion from a new risky asset from bleeding into the main liquidity pools.
Precisely. And then finally, V3 brought in Portal.
Which was a huge quality of life upgrade for anyone using Aave on multiple blockchains.
It solved that massive headache of moving liquidity between different chains. It basically lets you burn your deposit tokens, the A tokens, on one network and instantly mint them on another.
So it's an almost instantaneous transfer of your claim on the asset.
Right, bypassing the usual slow and risky bridges.
So V3 really polished the smart contract efficiency and the multi-chain experience.
Yeah.
But running a protocol this large means the human layer, the governance, has to be just as sophisticated.
That raises a really important point. How do you manage a system that's supposed to be autonomous but still be able to react to a crisis in, minutes?
You need checks and balances and speed.
Exactly.
And this is where it gets really interesting. The Aave community, the DAO, is this massive group of token holders, delegators who pass their voting power to delegates.
They're the democratic arm. Yeah. But supporting them, you have the service providers. Think of them as the expert staff. These are specialized paid teams that do essential maintenance.
Like who? Give us some examples.
Well, you've got Chaos Labs and Lemurisk, who are totally focused on modeling and recommending risk parameters.
Okay.
Then you have Karpatky and Token Logic managing the DAO's treasury, Certora for security audits, and BGD Labs for core development. They're the engine room.
But when a real emergency hits a hack, a market collapse, a democratic vote takes way too long. And that's why they layered in the Guardians.
The Guardians are the highest security level. The nuclear option operating under a 5 of 9 multisig.
And they're split into two groups, right?
Right, based on how fast they need to react. First, you have the Protocol Emergency Guardian. They hold the critical emergency admin role.
So if there's an exploit, they can jump in within minutes to pause the markets.
Correct. This group is made up of the most active and trusted players in the DAO. Their power is immense, but it's for survival.
Then you have the Governance Emergency Guardian. Their job is a bit different.
A bit slower. Their job is to monitor the governance pipeline itself. If a malicious proposal somehow gets voted through, they can veto it during the 5-day on-chain verification period.
But even outside of those extreme cases, the DAO needed a way to react to just normal market changes, right? Without a full 5-day vote every time.
And that's where the stewards come in.
Okay, this is where I see a tension. The risk stewards are managed by a one-of-one multisig, one entity. Doesn't that just look like re-centralizing control to get speed?
That is a highly critical question, and the answer is that it's a very calculated trade-off. The DAO knowingly sacrifices a bit of decentralization for agility.
But there have to be checks on that power.
There are, and they're built into the code. That one-of-one multisig operates under strict on-chain constraints. For example, they can only increase a supply cap by, say, a maximum of 50% every 5 days.
So they can act fast, but they can't make a single catastrophic change overnight. The code itself limits their power.
Precisely. And then you have the GHO stewards, which is a slightly bigger group of 3 of 4 multisig. They manage the parameters for the GHO stablecoin to help it maintain its peg.
Okay, so we've covered the V3 fixes and this complex layered governance structure. Now, let's look at the future. Aave V4. What was the driving reason for another huge overhaul?
The rationale for V4 is more strategic than just technical. V3, for all its improvements, still has what you'd call a monolithic architecture.
Like a single giant building where everything happens in one place.
That's a great way to put it. And it means every new market has to bootstrap its own liquidity from scratch. It fragments the capital.
A sprawling city with no unified downtown.
Exactly. And critically, V3 had no native way to price risk beyond just what asset you were using. If I supply high-quality WETH versus a riskier token, I pay the same interest rate. That doesn't make sense at scale.
So V4 introduces the hub-and-spoke model to fix this.
That is the core change. The liquidity hub is the central contract, the main pool where all capital is pooled and stays fungible.
Unified downtown.
Right. And the spokes are these independently deployable modules. Think of them as specialized districts, like one for E-mode, one for isolation mode. They register with the hub.
And they draw liquidity from that unified hub, use it for whatever their purpose is, and then return a base rate plus something new.
A risk premium. That risk premium is the strategic lever that V4 needs to even think about handling trillions of dollars. It replaces the old uniform rates with a system that actually prices credit based on collateral quality.
How does that work in practice?
The protocol calculates a collateral risk score from 0 to 1,000% for every asset in a spoke. Then it aggregates that into a personalized user risk premium for the borrower.
So if I supply really high-quality collateral like WETH, I pay just the base rate.
Just the base rate.
Yeah.
But if you're using riskier, more volatile tokens, you pay a surcharge that scales with that risk. It's smart incentive alignment.
That is fascinating. But doesn't this new fee structure kind of penalize smaller users who might only hold riskier assets?
It definitely increases the cost of borrowing for riskier positions, but that's really the point of the system. It builds resilience. For Aave to credibly attract institutional capital or huge RWA deposits, it has to be able to differentiate risk internally.
This pushes the whole system toward higher quality collateral.
Or it correctly prices the risk if you don't use it. It's the strategic move Aave has to make to scale up to that institutional level.
And that strategic thinking extends to user safety, too, with something called dynamic risk configuration.
Yes, this is a huge deal. In V3, if governance voted to lower the LTV on an asset, that change hit every open position immediately.
So you could wake up one morning and suddenly be close to liquidation, even though you didn't do anything.
It was a massive pain point. V4 fixes this. Every time governance changes a parameter, it assigns a new risk config ID. Your existing position keeps the ID it started with.
You're grandfathered in.
You're grandfathered in until you take a new risk-increasing action, like borrowing more. It just makes everything far more predictable for the user.
They also changed how liquidations work, moving away from those fixed percentages.
They did. The liquidation engine V4 is much more precise. V3 was like using a sledgehammer to kill a mosquito.
Yeah.
They take a huge chunk of your collateral for a small debt.
Mm.
V4 is like a laser. Liquidations now only sees just enough collateral to get your position back to a safe, governance-defined health factor. It's much fairer.
And this modularity, it seems like it also opens the door for future innovation. I saw things like position managers and reinvestment modules mentioned.
Indeed. Modularity unlocks things like position managers' contracts that can execute complex actions on your behalf, or reinvestment modules, which can take idle capital from the hub and allocate it to external yield strategies.
Turning idle capital into active, productive capital.
Subject to governance approval, of course, but yes.
And this entire architecture is what underpins that massive 2026 vision. What are the big targets there?
The vision rests on V4, but it's driven by two key goals. First, expanding real-world asset deposits in their horizon market to over $1 billion.
$1 billion in RWA.
And second, a major mobile app push, aiming for the first 1 million users. The CEO called the mobile app the Trojan horse to bring DeFi into the mainstream.
So what does this all really mean for you, the listener? We've seen this massive necessary pivot from Aave. It's shifting DeFi from a single pool model to something far more sophisticated.
A modular, risk-differentiated architecture. And the complexity of running this thing at scale requires layering everything together. Democratic governance from the token holders.
With the emergency controls of the guardians and the operational speed of the stewards.
And all of that human infrastructure is built on top of smart contracts that are constantly evolving to protect users with features like E-mode, dynamic risk settings, and now these transparent risk premiums.
It's a multi-layered system of checks and balances, both human and code, designed to actually scale up to those promised trillions.
You know, what's really fascinating here is the trade-off V4 has made at its most fundamental level. Aave wants the core V4 contracts to be immutable once they launch.
Completely unchangeable for max security and auditability. Exactly.
Yeah.
But the architecture is designed so that the DAO could potentially layer minimal proxy contracts on top of it later if they absolutely needed to upgrade something. And that leaves us with a question. How long can a backbone of all finance really stay immutable before the pressure to innovate and integrate new things forces the community to choose flexibility over permanence? That's something to really mull over as this new system rolls out.